It's obviously interesting, times with the Bitcoin market. But my view is, with regards to seeing a lot of FUD around strategy having to sell Bitcoin. I think I couldn't disagree any stronger with that FUD. Strive is in a similarly strong position, and I think that the market will learn a lot of the resiliency of digital credit through this type of a bear market. My base case is that this is probably going to be a bear market on the shorter side than the longer side. But regardless, these type of moves are never a surprise, right? And so I think if you're well prepared, both on a personal basis and on a corporate basis, you ride them out as they go through. You can check if you were personally over leveraged, right? Like if you're having to sell in these environments, or you can't sleep because of the losses. That's probably a sign that in some way you over levered yourself, right? Like, and if you haven't, then you can sleep really well, looking at the fundamentals of all the fiat currencies collapsing over the course of the next 5-10 years, and you'll benefit from that over time with Bitcoin exposure.
How many chairs are you sitting on right now?
Hello, everyone, and welcome to One Chair. Today, we sat down with Matt Cole, who's the chairman and CEO of Strive. We went deep on Strive's evolution and the strategic rationale behind their merger with Semler. Then Matt walked us through why and how Strive moved so quickly to retire Semler's debt and what that says about their capital allocation priorities. We also discussed the current Bitcoin bear market and what it really means to build a successful Bitcoin Treasury company in this tough macro environment. And then we had some broader thoughts on strategy, execution, and what really matters going forward for Bitcoin Treasury companies. So let's get right into it. Here's our interview with Matt Cole. All right, Matt Cole, welcome to the One Chair podcast. It's an honor to have you on.
Thanks, guys. Honor to be here, and a fun time to be here to talk some Bitcoin Treasury companies, Bitcoin, and digital credit.
Yes, we'll dig into all of that. Maybe first, could you briefly let us know how you went from managing 70 billion at CalPERS, a big pension fund in traditional finance, and then moving into the Bitcoin space and then leading a Bitcoin Treasury company?
Yeah, so I was at CalPERS for about 16 years. I as you noted, managed a $70 billion fixed income portfolio for about 11 of those 16 years. It was actively managed, outperformed my benchmark every single year, was one of the top performing investors in the entire industry, and notably became personally all in as a Bitcoiner in late 2016 and early 2017. It was a confluence of what I would say skill and luck, both colliding to basically have me put 100% of my liquid net worth into Bitcoin over that period of a handful of months, after several years of research and I would say institutional skepticism of Bitcoin, call it in the 2013, 2014 era, that I thought as an institutional investor that there's no way these internet kids knew something that I didn't. But talking, one of the portfolios I managed was the U.S. Treasury portfolio at CalPERS, and so I had direct access to the Fed, to the Treasury. CalPERS, for those that don't know, is the largest pension fund in the United States, and so our Treasury portfolio was one of the largest Treasury portfolios in the United States. Overseas, you start to go down. We're still large, but less large. But in the United States, one of the largest portfolios, and so talking to the Treasury and the Fed in the era of QE. I quickly became very skeptical of QE, of what it was and how it was described. And I've talked about it as being gaslit by the Fed and the Treasury, where they would talk about it not being money printing and give you all these academic, institutional answers, managerial class answers, is what I would call them. But then if you started to challenge it, it quickly, what they would say, broke down, where the only reason what they were doing was not technically money printing was the Fed would issue, or the Treasury would issue new bonds. They would sell them to the Wall Street banks like Goldman Sachs, and then the Fed would buy them from the Wall Street banks. And because of that intermediary, it was not considered a direct monetization of the U.S. debt. But if it was to go from directly the Treasury to the Fed, everyone would agree, including the Fed and the Treasury, that it was monetization of the debt, that it was money printing. And so all they were doing effectively was legally laundering hundreds of billions of dollars through the Wall Street banks and paying the Wall Street banks a spread to do that, so the Wall Street banks made money, and monetizing the debt. And that made me a Bitcoiner in a major way. And it actually rings really important to what's going on today with the Warsh nomination to the Fed chair, and he's been a QE skeptic, and kind of his journey, and I think that's filtering through into asset prices today, where I would say you kind of have this like temper tantrum going on, bear market going on, that's caused by a concern of a hawk potentially leading the Fed. But the problem is, and why that argument breaks down very quickly, and this is similar to what I would say is previous Bitcoin bear markets, where you have bearishness happen, but the fundamentals, the underlying fundamentals, are as bullish as they've always been. I think that's where we are today. In that the problem has never been the Fed. The problem is the debt crisis in the country, the Treasury, the Congress, that they can't stop spending money. And what happens is that, and you've seen this is kind of where my background comes in, is that you see liquidity conditions break down. You see effectively signs that the Treasury market could literally fail, which would then mean the dollar falls. And then the Fed steps in to save the day. And so we already know that there's not enough liquidity, there's not enough natural buyers of treasuries. And so the Fed really has two options. They can continue to print money, which I call giving medicine to the treasury market to keep it functioning, although it's terminally ill, or they could not give it medicine and it will just die. And so as like a Bitcoiner, I sleep really well at night. And even in this market, and we're recording this, as Bitcoin's going down below 75K for the first time, obviously painful environment for, amplified Bitcoin treasury companies on a, weekly basis on their stock price. But just zooming out, which is what we talked through at Strive, and kind of why we've structurally built digital credit like strategy, is that from a long-term time horizon, the fundamentals have never been stronger. And we've always underwritten, and this is kind of my background, pensions. Pensions think in terms of decades. They don't think in terms of a week or a month. They say, okay, what is the backdrop that we're underwriting risk and return opportunities in? Does that thesis still hold? And for Bitcoin, the thesis is basically you're underwriting, in our view, like a 30% CAGR plus on Bitcoin over the course of a decade with very high volatility. And so you're actually underwriting bear markets like we see today, right? Like we're not predicting, or we didn't predict that today Bitcoin would be 74,000 or this specific bear market, but we 100% predicted and foresaw 30 to 50% declines in Bitcoin as part of the journey of what I would say is a super cycle that, people would probably laugh at the term super cycle today when Bitcoin's down so much, but I think we're still in a super cycle at this point. What is a super cycle? I would say it's underwriting around 50% or less declines kind of going forward in Bitcoin with faster cycles versus Bitcoin's history with 80% plus declines, 4-year cycles. Like I think it's been pretty well covered, the breakdown of the 4-year cycle. What does that mean? It should mean probably shorter time cycles, still with dips, 30 to 50% dips. And until and unless we have a return of a 4-year cycle with an 80% plus drawdown in Bitcoin, which, do the math on 80% drawdown of around $125,000. And what you'll see is around a $30,000 or less Bitcoin price. And it's like, does anybody really think we're going down to 30,000 here? I don't. It's possible. We don't have Bitcoin encumbered, so if it did, it's not like we'd be liquidated. But I don't really foresee us going substantially lower than here. Could it go to 60K? Yeah. Could it go to 50K? I don't think so, but possibly. Do I think it goes to 30K? I'd say it's very unlikely. And even if it does, I think the question becomes, is it like a flush out over the course of a week, or is it long term? And so that's how we've taken this long-term mindset at Strive. My pension background, our chief risk officer, Jeff Walton, coming from the reinsurance industry, Ben Workman coming from the consulting industry, working with, players like Fannie Mae. Like, we don't think in terms of a week or a month or even 1 year, right? We're thinking in terms of years, and strategies thinking about that as well. And that's why, right before we started recording, is like, I love these bear markets. I love more when we have the upward market and we're kind of going up and to the right, but these bear markets, they actually give you the opportunity to prove the thesis out, right? Like the the people that don't understand, like I just got a message from, an investor and it was like, you know, I'm concerned that strategy is going to have to sell a bunch of Bitcoin in this bear market. I'm like, let's talk tomorrow. Because I just do not agree at all. Like I look at their balance sheet and I'm like, I mean, first off, Sailor's buying like every week right now, including in this downturn. Now it's not really generating much yield, right? It's kind of like yield neutral buying, but where is the balance sheet breakdown where they're going to be forced selling? I just I don't see it unless your view is that we're going to enter a 5-year plus bear market. Well, then okay, like I could see some risk in having to sell some Bitcoin, not bankruptcy, but having to sell some Bitcoin. But that they're going to have to sell this year, it's like, come on, like what are you underwriting? Like let's chat. So, anyways, that's my background and kind of why we tend to be very biased to think towards the long term, which I think's been smart for our company.
Yeah, and we're not even 50% down from the highs, right? That would be in the mid 60s. So a super cycle is still in the cards here. You mentioned that during a bear market, you would see which companies have a resilient strategy, right? And obviously, your company is one of the only ones that has prefs out with a strategy and Metaplanet to come soon. But there's not a lot out there. And do you think those companies are in a stronger position now, even if we go into a longer bear market here?
Yeah. So I think the question becomes, how long of a bear market? So I think for if you're underwriting basically a 4-year cycle or less, I think that digital credit focused Bitcoin treasury companies are very unlikely to have to sell any Bitcoin. Okay, so I guess the question becomes, do you think that we're entering into a 5 or 6 year bear market? I don't, but I guess if you do and you're like a perma bear on Bitcoin, I don't really know why we would even be having a conversation of if you think that amplified Bitcoin exposure makes sense. But there's these companies there's it's not magic, right? Like what's happening with digital credit's not magic. I would say it's very smart, in my view, financial engineering to say Bitcoin, you're going to underwrite that it's going up over the course of years, and that it could do anything over the course of any 1 year. And you're saying, look, I don't really want to care about what Bitcoin does over a given year or 2 year or even 3 years, but over 4 years plus, I think Bitcoin's going to go up and to the right. And if that thesis holds, I do think that digital credit will age really well. Like we're kind of, digital credit just passed its 1 year anniversary. I think Strategy over the weekend had a tweet about, 1 year since their first pref. And you just think about that and you're like, man, how much has happened in 1 year? Like I feel like we're all in dog years here in the in Bitcoin space, but even more so in Bitcoin treasury space, right? But it's only been 1 year, and so coming from a asset management background, asset managers typically don't even start to say they've had a track record until 3 years. And so the question becomes, is Strategy, is Strive, Metaplanet's newer to the press. They don't really have a ton out yet. So, I mean, it's, but like people that are actually have like true amplification, which like Strive has just over 40% amplification. If you don't know what's going on, you might look at that and be like, "Oh my goodness, that's scary, 40% application." If you're a Bitcoin bull and you're underwriting kind of a super cycle, you'd be like, "Oh my gosh, like Bitcoin 74,000, they have 40% amplification, almost no debt, and they're going to try it." Like that's an opportunity, right? So it just really comes down to kind of how you underwrite risk, and we underwrite it from the perspective of kind of a perma bull over the course of 4 years. And so I think we're well positioned, and I think the question becomes, what would let's say we're in a bear market. So my view is that we are actually in a bear market. I think it's at this point pretty obvious. My base case would be that this is going to be amongst the shortest, if not the shortest, bear markets in Bitcoin's history. But we are in a bear market. So let's say that we come out of the bear market in whatever, sometime between 6 months and 2 years from now. Okay, let's just put some time frame on it. What would be a smashing success for Strive and for Strategy? I would say that if you could meet all your interest obligations for the prefs, you don't sell Bitcoin, and the yield during a bear market is neutral to positive. If those three things were true, think about that from a looking back perspective in like 2028, when like you're like, oh, like, yeah, we underwrit digital credit. We had a bear market. Everybody thought that Strategy was going to have to sell Bitcoin or Strive was going to sell Bitcoin. We sold none. We met all of our interest obligations. The risk premium for that type of a company goes down a lot. And so I think that's my base case of what I think is going to happen over the next couple of years. With regards to some of the peers, I mean, the what is public is not known. So I think it's kind of a mixed bag. You have some players that basically haven't done a lot. They don't have like any leverage. They don't have any amplification. They're just kind of new in their strategy. So they're just kind of sitting on Bitcoin. And so, I mean, they're probably not for sellers. You probably have some that have taken out debt or converts that might have encumbered their Bitcoin that might be at risk. I don't think this is anything like a systemic risk to Bitcoin. Frankly, like all these players, they just don't hold enough Bitcoin. I mean, they probably combined hold as much Bitcoin as Strategy buys in a month. So like, it's not like a systemic risk, but do I think that there is a chance across the ecosystem that one or a handful of the players end up being, having to sell some Bitcoin? I do. Do I think that there's a risk of bankruptcies? Very unlikely. I mean, you're talking about balance sheet companies, right? Like, I think when you think about a balance sheet company failing, like a Bitcoin balance sheet company, I think the question is more of, are they going to outperform the Bitcoin hurdle rate, or even have they set Bitcoin to the hurdle rate, and are they going to outperform it, or are they going to have a drag because of some of their terms? I think that's the likely scenario of kind of how this plays out. But I think it's going to age really well for digital credit, and it's a welcome bear market that, getting through this, I think will do a lot of things. But like I said, I think it will drive down the cost of capital over the long run to be able to, this is an institutional story. Like, it's a retail story, but if you look at, who is in the order books of, like the SATA fundraises, when you see it, or the Strategy ones, it's a lot of big asset managers, right, that are long-term holders. And then there's a lot of other ones that are looking at it that haven't allocated yet. And it's very helpful to actually go through one of these and be like, you were skeptical, look what happened. Like, okay, now, SATA was, whatever, 12% or whatever, it ends up being through this. Now, the cost of capital is going to go down because we've proven ourselves. Like, Strategy being rated by S&P B minus, like, that was too risky of a rating. Like these, and I think that's what's at play, and why these periods should be looked at as great opportunities, which is, I know how Saylor looks at it, it's how I look at it too.
Yeah, I think another success factor of getting through a bear market would be to also being able to accumulate more Bitcoin, stack more Bitcoin that is cheap, right? And when we saw the bear market of 2022, Strategy, they survived, but they were not able to stack a lot during that period, right? They were barely surviving, and this might be different this time around, right? If Strive's SATA or Strategy's STRC stay at par, and they're able to, or you're able to issue more prefs in a bear market, then you could stack a lot of Bitcoin, and that is cheap, right? So that would be another scenario that is quite positive.
Yeah, I would say that's the, if you're giving a grade, that's like the A+ grade, right? Like, I think if you're, the goal of these companies is to provide amplified Bitcoin exposure, right? Like, as an operating company, so have a business that, sets Bitcoin as its hurdle rate and outperforms Bitcoin over the long run. Buying Bitcoin in a bear market, I don't think is a necessity for that. But I think if it's possible to be done in a neutral to accretive manner, I think you can help dampen the volatility to Bitcoin on the downside by being a buyer, right? When other people don't have liquidity. And, but I think when you look at market expectations, right, like, market expectations are important to look at. Like, y'all underwrite deep Bitcoin risk. You understand this in a deep level. Even the institutions, most of them aren't at that level, right? Like you have institutions concerned that Strategy is going to be a forced Bitcoin seller, right? So just not having that be true is a massive win for trillions of dollars of capital, right? If you're a net buyer, then even better, right? But it shows you how early we are in this industry to prove kind of what the risk and the return opportunity is.
One question on your USD reserve. In the Bitcoin Treasury space, you have Strategy at the forefront of this financial engineering, and then other companies copying Strategy. And in this case, Strive was first, actually, setting up with SATA, setting up a USD reserve to be able to pay out dividends years out. And Strategy copied it a few months after. What was your reasoning for setting up this reserve from the get-go?
So ultimately, we lean really heavily into the messaging that, the prefs and SATA is amplification. It's not leverage. It's not debt, right? Because it is preferred equity, but it is financing, right? Like there is an interest liability that's attached to this, right? And ultimately, like, why are we doing this? We're doing this to try to provide a great product in SATA, but also provide amplification and properly match the duration of Bitcoin, which obviously doesn't have inherent cash flows in it, as as the haters would say, it has no intrinsic value, right? But like obviously we understand what the opportunity here is with Bitcoin, but how do you match a long duration asset with a long duration liability? The best way to do that is with the preferred equity, which Strategy pioneered, and we were second out the gates with SATA. But then the question becomes, okay, what type of risk are we underwriting here? And there is downside risk to Bitcoin, even underwriting at a 30% CAGR with the volatility. We're seeing it today, right? And so it was not we intentionally do not make predictions of when we will enter a bear market, right? Like we're kind of terminally underwriting a 30% CAGR with kind of Monte Carlo simulations and a ton of different scenarios. And some of them are downside scenarios like we're witnessing today. And so the question becomes, how do you get comfortable about surviving that downside scenario with room to kind of grow out of it, right? And so that was the concept of the cash reserve, where we felt like it better matched the risks to the opportunities, right? Where when you look at, like, as an example right now, so in my view, I think from a fundamental perspective, I couldn't be more bullish Bitcoin, but I think the breakdown and price that Bitcoin has seen over the last week has only happened, kind of as I look at it, three other times in Bitcoin's history: in 2014, in 2018, and in 2022. Okay, so the question becomes, okay, like, what was the duration of downside markets during those three downturns? And as a company, do we think that we bias this current environment to be, shorter duration or longer duration? And so just to say, like, from those three breakdowns that I talked about, the duration of the bear market before it recovered its previous level. So like in this instance, I would say recover like 88,000 or something like that on Bitcoin. Like, how long historically would it take to recover that? And the answer is it's historically been 6 to 20 months. 20 months was the longest example, 6 months was the shortest example. So our base case would be, that it's probably on the shorter end, of like 6 months or maybe even less when I look at some of the conditions and kind of the breakdown of the 4-year cycle. But can we underwrite it to the long end, right? To ride out like the 20-month. And so that was why we started with a 12-month reserve, right? And there's several additional things that we could do over the course of 12 months. It's not like we're just going to sit here and do nothing, right? But we could literally sit there and do nothing for 12 months and wake up and see where the price of Bitcoin is. Obviously, if you know the Strive team and you know the speed we do things at, that's definitely not what we're doing. But the point was to get a buffer in, right? So that way, when liquidity conditions change, the company isn't instantly in a bad position, right? And so Strategy quickly adopted that. I think the market liked a cash reserve, and then the question kind of becomes, how what's the right duration of a cash reserve? Kind of what are the options of a company? And my view is, generally speaking, somewhere in the realm of like a 12 to 18-month cash reserve is appropriate when you look at historical downturns in Bitcoin. And there's obviously other ways to think about generating, a yield on Bitcoin. Metaplanet's been doing that, right? Generating profits off of their Bitcoin. And importantly for us, like, we haven't done anything there yet, right? But we've been very mindful of not encumbering any of our Bitcoin. So right now, none of Strive's Bitcoin is encumbered. Prior to the Semler acquisition, we had no Bitcoin encumbered. When we acquired Semler's Bitcoin, a small percentage of their Bitcoin was encumbered to their Coinbase loan. They had $120 million of debt. We retired $110 million of that within 2 weeks of the close of the transaction, have no Bitcoin encumbered, and then have cash set aside to already retire the remaining 10 million by April. So we're in a good position where we have amplification on, we have no encumbered Bitcoin, which means we have optionality, right? To consider yield opportunities if we found them attractive. And I can't really speak much more to that at this point, other than to say, you know, if you would have encumbered your Bitcoin, so like some people, we turned down convertible notes because they were going to require us to, encumber our Bitcoin. We didn't feel comfortable with that. If they're encumbered for debt or even for amplification, which ours isn't, then you can't use your Bitcoin for any other purpose, right? Like you're just stuck in that. You couldn't do what Metaplanet's doing, right? You couldn't consider other options, right? And so we have no unencumbered Bitcoin, which means that we have other sources of optionality that we could consider if we felt like the risk return was appropriate for our shareholders to drive a long-term value.
Yeah. So you've just mentioned exactly that you have acquired now Semler Scientific, and I want to get back to that in a moment. But since we talked about the USD reserve, and we've seen strategy move in that direction as well, and I believe from Michael's speech, it feels like it's very much done to improve their credit rating. So are you also looking to, or are you pursuing a credit rating for Strive or its preferreds?
We're definitely considering it. So we're having those types of conversations every day. I think the question really becomes: are the credit rating agencies ready and willing to give some credit to the balance sheet, the Bitcoin balance sheet? If you look at S&P's credit rating, right, like it was really a bizarre credit rating, right? Where they gave no credit to the Bitcoin. So it's like, okay, pretend Strategy has no Bitcoin and look at those convertible notes. Those convertible notes are pretty scary over there, right? Like, and I kind of am of the viewpoint that that analysis is just garbage currently. And so, the way I've approached it is, when we've had some of these conversations with institutional investors for SATA or the SATA follow on, it's actually just to shine a light on that and be like, because when I was at CalPERS, I mean, we looked at rating agencies, but we were sophisticated enough to underwrite ourselves. Like we could do an override. So some can, some can't. But for the ones that are more sophisticated, say like, look, guys, like look at how S&P rated Strategy. Okay, do you agree that there should be some credit to the fact that they have 700,000 Bitcoin? Like, they're like, yeah, of course. Okay, they gave them no credit. So can we agree that the B minus rating is too low? Like, we can disagree on how high it should be. My view is it should be A rated, but like, or triple A rated, but not even just investment grade, but it should be higher than it is. And they're like, okay, yeah, like I can get comfortable with that. And then let's secondarily, let's look at one of the, criticisms of S&P. It was the convertible notes of Strategy. Well, Strive has no convertible notes. So, you can underwrite that and you can think that through in an internal model. And this kind of gets into a lot of the different, metrics that, institutions look for, right? Like the most important ones being liquidity of the stock. So like our liquidity relative to, I think the broader Bitcoin Treasury space on a per Bitcoin basis and outright just off the charts high, and it continues to be off the charts high. They want to look at kind of the market cap. So like, if you're too small, you're kind of uninvestable, but they want to be able to allocate size. You need liquidity. And then they want to feel comfortable with the risk, profile of it. And then kind of the last thing, and this is like a distant last thing, but several institutions then have compliance, restrictions on stock prices below $3, $5, $7, right? And so then you kind of check those boxes and say like, what are the most important things that Strive can do to open every door, right? And one of them was our stock price. So we're doing a reverse split, and that'll pump the price up. And it's not just, I think a lot of people think about it as the dollar floor. And when you actually kind of go through the mechanics of that, it doesn't really make sense. So like you basically have, 6 months to a year to get your price over a dollar. So like you kind of look at that at like a lot of the players, like what are the chances that that'll work over the next, year? Probably like 60% plus in our favor that we wouldn't have to. But then you say, well, if you believe that you're the best institutional story, so like we've accomplished the corporate structure that strategy is trying to get to by 2029. We want to go tell that story to every institution, right, over the course of the next several years. We talked about kind of building a track record through the prefs. Like we view this as an institutional story with, as it's early, the opportunity for retail to kind of be early and front run some of the institutionals that we think will come, right, that we want to check every box. And so eventually one of those boxes is likely a rating. But the rating needs to make sense, right? So I think right now it's a lot of education to the rating agencies, and there's more than just three, right? There's more than just S&P, Fitch, and Moody's. There's other ones that tend to be a little bit more innovative in approach, and I've worked with them in my past when I did a lot of structured products and kind of know some of them. So we're having those conversations, and I'd say that we're interested if the methodology is one that is at least fair. They don't have to be as bullish on Bitcoin as me, but they at least have to say, okay, this company has a large balance sheet. We're gonna give them some credit for that.
Coming back to the Semler Scientific acquisition, so you had those discussions back at the unconference, and there. So what made you confident that there was synergies, and maybe can you tell us what was the most important factor that made you confident that that was the right move for Strive?
Mhm. Yeah, so the thing that made us the most comfortable was just that it was an accretive Bitcoin acquisition for Strive. And so if you look at our yield metrics on the quarter to date, I mean, this has been obviously a very challenging quarter, to say the least, right? January and early February for Bitcoin Treasury companies, and most have basically have no yield, right? And our quarter to date Bitcoin yield is about 21% right now. About 15% of that is from the Semler acquisition, right? That was the yield because the price dynamics were in the favor of Strive generating a positive Bitcoin yield. But that's obviously the next question is, well, like, why did Semler do it, and what was the win-win? Like, you have to think in terms of, use a Trumpism, the art of the deal. Like how do you present a win-win? And the basics was that, Strive had the clear opportunity to be the leader in advancing digital credit from a corporate structure perspective, right? Like where Strategy is like the leader in digital credit at large. They have several digital credit offerings, way more size than us. But in corporate structure, we had the opportunity to be second and had a very clean structure because we had no debt. And so Semler saw this. I mean, they were the second Bitcoin treasury company in the US public Bitcoin treasury company after Strategy, right? So they were very innovative, but they were constrained in the size of their Bitcoin holdings. The fact that they had a convertible note, that their shareholders had actually voted down the pref. And I think some of that was concerns around the debt that they already had, right? And so Strive presented a vision to say, hey, we can bring you under here. We have a clean story. We think we can retire your debt, pretty quickly. I didn't realize we'd be able to do almost all of it in 2 weeks, but we thought we could do it quickly. I mean, that you have to actually have a conversation with market participants, right? Like we had to raise capital, raise SATA to retire that, but it came together very quickly, and that's how both sides became comfortable that teaming up together we're stronger than teaming up apart. And part of this is like, there's a game of skill that I think we talk about sometimes, but maybe sometimes people don't fully understand. Where when we raised the first offering to SATA, the IPO of SATA, we upsized it to $200 million. And one of the things that we talked to about that through that process is that the order book, so who was putting in orders for SATA, it was substantially stronger. There was way more demand at 200 million than there was at 125, which is where we initially said was the target fundraise. And the reason is that for many of the institutions, 125 million was too small. And in fact, 200 was like the smallest that they could even care. So they weren't like 200 is a large raise. They were like, okay, that's like at least enough that I'm willing to put in a bid, right? And so we had obviously more Bitcoin than Semler. And so you start to kind of go down the list and you say, okay, like raising a publicly traded digital credit preferred equity is going to be challenging at the current size of Bitcoin holdings and the current price of Bitcoin for most participants in the space, right? Like, are some of them able to figure out a way? Maybe, but it's challenging. It's very challenging, right? And so that was a clear value proposition that we could give to Semler. And then you add on top of that, they have an operating business. Right, it's preventative healthcare medical device that historically have been profitable, but have been challenged. And the other kind of value that we could drive was that we had several people very close to the hoop around Strive that had a lot of experience, deep experience in that field. One of them is our co-founder, Vivek Ramaswamy, who remains the largest shareholder of Strive today. Another is one of our board members that's now a full-time Strive employee, Ovik Roy, that also comes from the healthcare, medical device, biotech space. And then, we laid out a bigger vision to kind of expand that and take some learnings from what Vivek had previously done at Roivant, kind of building a parent co subsidiary with like a bunch of different products underneath it and monetize it and spin it out. And so that's not the focal point of like my day job. I'm focused on the Bitcoin Treasury company. So it was like Ben Workman or Jeff Walton or Ben Pham. But, Ovik is focused and, bringing in Vivek when necessary to actually put some pieces together around that and hopefully monetize it for our shareholders, right? Where Semler on its own was not going to be able to do that. And so you combine those and it was a pretty clear win-win opportunity. And I think as it goes, as this ages, I think we could offer win-wins for other players in the space. I think, it's some of them I think have business plans that are at the early stages and they're implementing them. Others are different places in the journey. And, I think we offer a ton of volume that a lot of them don't have, a clear structure. And so I would say we're open to additional M&A opportunities. We think we can present a win-win, but it again will have to be accretive to us in Bitcoin terms. Because I think that I think what we've done, it will be difficult for some of the players to replicate.
Yeah, absolutely. And exactly. So you mentioned that the Semler acquisition also brought these debts that you have in the meantime, I believe, retired up to 92%, if I'm not mistaken. And you did that by using an upsized on the follow-on offering on SATA at a fixed at $90 per share. Couldn't you have also done it maybe with the ATM, because I believe it's trading at a higher rate, and done it maybe not as quick, obviously, but then maybe over time? So what was the thought on that one?
Yes. So the question becomes, it's about liquidity conditions, right? Like if you want to raise, so we raised 200 million, of SATA. You look at the volume in the stock or the preferred equity, right? Preferred stock here, and say, okay, if I were to issue that, how much could I reasonably issue before I'm driving down the price of SATA in the open market, right? And the analysis simply shows that you would not have been able to drive anything close to the amount of volume. And you look at, as an example, you look at Stretch today, it's well outside of its band. It's not near 100, right? Like they're out of the market. And so the question becomes is, what is the probability of a downturn in Bitcoin? And are you comfortable carrying out that debt? So if we didn't do the SATA follow on we did, like we would 100% be out of the market right now. We would have a Bitcoin bear market. We'd have $120 million of debt. And instead of controlling our own destiny, we'd be praying for the market to recover. Right. And so that is it's a novel, like it makes sense, like in theory, like why don't you just issue the ATM at $100? But the question becomes like, how do you issue size in the most capital efficient manner? And I think this is where some of the market maybe didn't appreciate how successful the SATA follow-on was. And look, I think obviously strategy has been insanely successful of building out the pref market, but look at their journey and just kind of learn from it, and then say, okay, what did they do? What did Strive do? How is it different? How is it similar? Right. So strategy issued their first pref at $80, which Strive also issued ours at $80. They have not done a follow on yet. It'll be interesting to see if they do in the future. But then they issued an IPO of a second pref at $85. And then a third pref at $90. And then they did what was I can't remember what STRE was, but I think it was 90 or less. So I don't think that they've really IPO'd a pref. So when they're looking for size, right? Like they're looking to issue large size into the market, and that's where the market is for large size. And so, theoretically, like if we would have done a new pref and we would have done it at 85 cents on the dollar, that would have been the same trajectory from a cost of capital perspective as what strategy did, right? 80, 85, 90. They kind of stepped it up $5 at a time. We were able to go from 80 to 90 in one go round with the SATA follow on and control our own destiny. And I mean, I can't really I'm really glad we did, because I think when you look at, you never know where the market's going to go, but like if we were sitting there today, where we publicly state, intentions, which I think are good intentions to retire, all of Semler's debt within 12 months, and then we enter a Bitcoin bear market right afterwards, and SATA's at 90 cents on the dollar, and Bitcoin's at 76K, then you're sitting there, and it's important to note that with the Semler convert, and this is similar to most of the other smaller Bitcoin Treasury companies that have convertible notes, is that they have one convertible note that has one maturity at one date in the future, right? Where like strategy has like a handful of converts with different maturity dates, like a laddered maturity schedule, right? And so you're kind of in fixed income land, they call this a bullet maturity. Well, I don't want a bullet staring us in the face, right? Like we don't like debt, and so we really wanted to get rid of that. And then we obviously had the opportunity to upsize it. And then I think the question just becomes like, was that, was it smart or not to upsize the transaction? And obviously, if you can forecast that Bitcoin's going to go down to $76,000, then maybe in hindsight you could have done something different. But we only bought about $30 million of Bitcoin, which when you look at the size of our balance sheet was a pretty small buy. But we had a very strong order book, and we felt like it made sense to expand the holder base of SATA to a broader institutional ownership distribution. As we kind of grow our institutional story, and these are large buyers. These are buyers that can allocate hundreds of millions of dollars of more capital into the future if we need it, and we want to develop a relationship with them and get them on the SATA cap table. And so it's multifactorial in kind of how you think through these decisions, but I think the execution was really well, and I think it was very prudent to put the debt situation largely behind us, like we said, with the cash available to retire the last 10 million. And just to maybe speak to that for those that maybe don't know, there was a cap on how much of the convertible note we could retire in one instance, and so that 90% was the maximum that we could do. And so it's not like it was just legally in compliance, it was impossible for us to have it. So we raised the cash to just set it aside. It's there to go, but we have to wait until April to meet the what's in the documents.
Yeah, thanks a lot for this explanation. I think that it makes total sense. I think that there was another criticism I saw on X about the transaction. I think that there it's a bit clearer, but maybe you can address that too. Is why would you retire a debt where you have 4% interests on and replace it with the preferred where you have to pay 11-12% on?
So a couple different reasons. It goes into the case for digital credit in the first place of matching the assets to the liabilities, right? That if the only thing that you're looking at is the interest rate, you're looking at it in the wrong way. So these are convertible notes, and so when you upright to the upside, they convert into equity. And so what that means is when you think about this from an amplification perspective, right? Of like, we want to outperform Bitcoin over the long run. We want to provide amplified Bitcoin exposure. And then as Bitcoin rips, it converts into equity and dilutes the common equity holders, right? That is, in my view, it's negative convexity in both directions. To the upside, it converts to equity, right? Which means you lose your amplification when you want it the most, when Bitcoin's ripping. And then to the downside, you have debt. You actually have to pay it off, a fixed maturity, right? And so the reason that you get a less of an interest rate is because you have what's called negative convexity on both sides, right? So you're compensating the investors by giving them more security on the downside, right? A fixed maturity, and to the upside, conversion to equity. And so from my perspective, like as an investor, I love buying these converts. I think these converts are amazing investments because I think they're actually too costly of financing. But the financing is not just the interest rate. Because if you look at Semler's, you say, okay, well, Semler's was whatever 4%, and 4%. Well, Strategies was 0. So why did an investor give convertible notes to Strategy with 0 interest? Are they stupid? No, they're not stupid. They see upside in different ways, right? The downside protection and the upside conversion to equity. And so this gets into, would you rather give away the equity upside and provide a fixed guarantee to the downside with the lower interest? Or would you rather pay a higher interest if you're underwriting, kind of call it like we do, 30% plus CAGR for Bitcoin over the long run, which, most of these critics, I think, would also say the same thing, right? But then you say, okay, what's the total return look like to the upside? And to the downside, would you rather be paying a low double-digit yield, or would you rather have a bullet fixed maturity staring in your face? And I would rather pay the double digit, Bitcoin yield all day. I think it's not only it's a better source of financing. And I think that a lot of people struggle with this, and it's why you see the market at large, they get liquidated in Bitcoin downturns because they don't understand the convexity and the maturity risk. And so in every broader crypto market downturn, you see big people blow up because they didn't understand this liquidity, this maturity risk. And that's what we were trying to remove, right? To take the maximum duration. Well, if I'm going to take the maximum duration, I'm not going to take out debt, I'm going to take out equity. Then you have to give them something, right? You have to, otherwise they're not stupid. What are they going to do? So you give them yield, and that's what we're doing. And I think that's a better pairing of the risk to return opportunity for a Bitcoin treasury company.
Makes sense. One more question on SATA and the target range. It's a bit wider than what Strategy is offering between 99 and 101 for Strategy, and you're targeting 95 to 505.
105, yeah.
It because of liquidity reasons, because it's less liquid than a bigger product like Stretch, or what's the reason for this larger range?
Yes. So it's still early in the evolution of these products, right? Like you look today, Stretch, which I'm a huge fan of Stretch, massive fan of Stretch. I think it's a great product. It's outside of its band. It's been outside of its band, quite a bit. SATA today is also outside of its band, right? And so, as I think of these products as investment grade risk. But the yields would suggest that the market is not caught up to that thinking yet, right? Like double-digit yields is more of the market is underwriting these as high-yield securities, right? Which is where the opportunity is. And so I think as these securities evolve, we're going to understand both sides of the equation. So how much of the volatility of Bitcoin has these products stripped off? So like what is the actual volatility profile of digital credit in down markets, right? Like, and then what is it in up markets? And we don't know. I mean, the reality is that Stretch has been out substantially less than a year. The longest digital credit offering has been out for 1 year, right? And when I look at high yield, if you look at like HYG, the high yield ETF, it's the biggest high yield ETF out there. What you'll find is that in most markets, it's not volatile at all. It just kind of like sits there, kind of like does its thing. And then, volatility event happens and it comes down, draws down, and then it recovers back up. That's the story of high yield. Now, I think high yield, generally speaking, has been a substantially better investment, even through down markets, if you have a long-term holding mentality, than non-high yield fixed income. But the question becomes, for a product that's yielding over 12%, is it acceptable to have high yield volatility? Now, remember, high yield, the yield is like around 6.5%, right? High yield. So digital credit's like double that. So if I could say to an investor, hey, we think this is investment grade risk, it might have the volatility profile of high yield, right, which is kind of the band that we put in place. But you can earn, 12.25 interest payments. It's return of capital dividends. I think that's a product that will have trillions of dollars of demand, which is why no institution cared about our wider band. Now, if the market proves a tighter band, we could always move the band in, like if we thought that band is maintainable, right? So I think it just came down to, ultimately, what do we feel that we know about the market, we understand about the market, and we'd be happy to bring it in if the volatility of the product warranted it. So it is something that we would consider in the future.
So SATA has been obviously a huge success, and STRC on strategy side with the dividend rate variability. Are you also looking into bringing out new perpetual preferreds, probably similar to what strategy has, obviously maybe on your own versions?
It's possible, but I hope the answer is no. And so we're intentionally trying to keep a very simple capital structure. So we have our common stock, ASST, as amplified Bitcoin, and then we have digital credit, SATA. And so we've been able to accomplish an amplification ratio, which I think is like kind of like right in range of what we would ideally have, right? So we're in like the low 40s right now with one product. Strategy, their biggest challenge is, and I think the haters will say the biggest challenge is going to get liquidated. The biggest challenge is actually that they have 700,000 Bitcoin, right? And they have to figure out how to amplify appropriately that 700,000 Bitcoin. And so it necessitates building out a deep and diversified and multi-jurisdictional digital credit market, because they have so much Bitcoin that they want to amplify the exposure of, right? So it's a luxurious problem of the massive success that they've had, but it's a legitimate problem for their company, where Strive has, because of our smaller size, been able to get the amplification that we desire just through SATA. And so I think even in Bitcoin bull markets, I think there's a reasonable chance that with the ATM that we'd be able to keep amplification where we'd want with SATA. If the markets ripped so quickly and the liquidity wasn't there in SATA, then we would definitely consider another preferred equity. But I would say that the goal would be to keep the structure as simple as possible.
Thanks for the clarification there.
Anything else you want to touch on, Matt, before we wrap up here?
No, I think this has been, a great conversation. It's obviously interesting, times with the Bitcoin market. But my view is, with regards to, you're seeing a lot of FUD around strategy having to sell Bitcoin. I think I couldn't disagree any stronger with that FUD. Strive is in a similarly strong position, and I think that the market will learn a lot of the resiliency of digital credit through this type of a bear market. I'll reiterate that my base case is that this is probably going to be a bear market on the shorter side than the longer side. But regardless, it's these types of moves should not be a surprise. The timing will always be a surprise for me, because I'm not smart enough to pick the exact day or the month, but these type of moves are never a surprise, right? And so I think if you're well prepared, both on a personal basis and on a corporate basis, you ride them out, and you obviously understand as they go through. You can check if you were personally over leveraged, right? Like if you're having to sell in these environments, or you can't sleep because of the losses, that's probably a sign that in some way you over levered yourself, right? Like, and if you haven't, then you can sleep really well, looking at the fundamentals of all the fiat currencies collapsing over the course of the next 5-10 years, and you'll benefit from that over time with Bitcoin exposure.
Yeah, I think that will be one of the positives out of this bear market is we'll see how resilient those companies are, at least the ones that manage it correctly. And I just saw today on X that there's a 10% chance on Polymarket that strategy will announce bankruptcy this year. So
I saw that, and then I was like, who that understands this market would ever buy that contract, because it was like a 2-year contract that pays 10%. It's like, just buy stretch, call it a day if that's what
Yeah.
you want.
Yeah, of course. All right. Before we wrap up, where can people find you?
Yeah, easiest place is on X at Cole Macro, and then company is at Strive on X.
Well, thanks a lot for your time. It was a great discussion, and I appreciate you coming on.
Thanks, guys.
How many chairs are you sitting on right now?